Welcome to Smashed Avo Property. Today I'm speaking with former guest of the podcast, a great friend of mine, and the founder of Your Property, Your Wealth buyers agency, Daniel Walsh. And today is all about mindset. Mindset is so critical to the success of building your portfolio, and during large economic events like we're seeing today, our mindsets often get tried and tested, and it's easy to lose sight of our original goals.
Well, I've had to go through a lot of these micro failures where people now look at me and say, oh, that wasn't a failure, look where you are now. No, it wasn't a failure, but what it did do is it taught me not to do that again so that I could make more money in the future. So I think it just comes down to how you look.
As always, seek your own professional financial, legal, taxation, and property investing advice for your current situation. Everything we talk about is just our opinion and general in nature and should never be considered as personal advice. So without any further ado, let's get house hunting with Daniel. Daniel Walsh, welcome back to Smashed Avo Property.
Thanks, Jordan. Thanks for having me back again.
Mate, I am absolutely rapt to be talking to you one more time. You're a bit of a legend in my eyes and got some great insight. So I'm keen to delve in today. And you and I were catching up last week and decided that we should do something on mindset. And I think it's a big one that a lot of people get confused about. What do they think? What do they think about the markets? What do they hear in the media? All of the FOMO, the fear of missing out, the buyer's remorse. As soon as you buy it, you're kind of like, oh, did I buy the right property? Did I not? And there's a lot that goes into buying property and strategically thinking about property and building a portfolio. And I think, not only yourself with your portfolio, how you've managed to build that over the years, but what you do for your clients. I couldn't think of anyone better to have that conversation with. And I'm really keen to delve into it, mate. How are you feeling about the topic?
Mate, it's probably one of the topics that I love talking about is mindset. I do believe that, a lot of my success over the last decade in investing, creating wealth has come down to the mindset side of things. And I talk about that, with a lot of people because what I actually say to people is the difference that sets you apart is your mindset. If you have a weak mindset, then, you're probably not going to achieve very much over the next 10, 20 years in investing because at the end of the day, you're going to be swayed into all these different ways, different avenues, and all of a sudden you start to get clouded, your judgment gets clouded on what you really need to be doing to create, success for yourself. So for me, I've been just very laser focused. I work on my mindset almost on a daily basis to make sure that, I'm not having people, family or friends or, the outside media, come in and corrupt what my mindset is telling me. And what I want to do is make sure I'm achieving my goals, and I need to be laser focused for that. I need to have a strong mindset. And one thing with mindset is your mindset can be corrupted. And a lot of people's mindset does get corrupted because they're listening to so many outside influences. And that's why I want to talk about this topic, because I know that this is what separates a good investor from an average investor over time. And I've seen it play out with multiple clients, with many people that are investors that haven't been successful. And I usually talk with them for a little bit, and then I come to the root of the problem, and it's mindset. They have no clear direction. Their mindset is broken because they're listening to so many different people that they don't even know what they're trying to achieve at the end of the day. So I think this is a very good topic to be talking about.
Yeah, spot on, mate. And it's so easy to do. Like, it's so easy to read a news article of 30% property price crashes and you think, oh, why have I invested in property for? And you start to freak out and think, oh, maybe I've got to sell my property. Maybe I should get out before it does crash. And then, people are making massive financial decisions based on one little news headline article that was designed to get clicks. And it's so sad to see. And I think that's why it's so essential to have this conversation with someone like yourself. But I think we'll delve straight in because I'm sure we'll get pretty deep into it like we usually do. But first and foremost, becoming a property investor seems impossible to some. Like, it just seems like how can I afford a $500,000 property? How can I afford a $1 million property? Especially trying to save that initial deposit. And how do most people overcome that mindset?
I think the most important thing is to understand that you don't need to invest in your backyard. So a lot of people that might be investing in their own backyard or thinking of doing that, they may be in for $1 million if they had to do that. Whereas, if you can think Australia-wide and then really understand what makes a good investment property, that you don't really need to spend $1 million. You can spend $300,000, $400,000, so you can make it much more affordable for you to jump into the property market. And I did that for myself. Even in my total portfolio to date, I've never bought a property over $380,000. And yet I've been able to create now $2.2 million worth of equity in about 9 years. And I've done that from affordable properties. So I think that anyone can jump into those types of properties. It's still going to take dedication. It's still going to take a strong mindset to be able to save the money required to get into the first property. However, I do think that people need to understand that delayed gratification in this instance is what you need. You know, for me, I know that when I started out investing, it took me 4 years to save for my first deposit. Then when I got my first deposit, I finally bought a property, and then it took me another year to get into the second property. Then I actually had a break for 2 years. So I think that what people want is we always hear, you underestimate what you can do in a 10-year period, and you overestimate what you can do in a 1 year period. So people get deterred from, saying, I'm going to get this property in the next 12 months. However, 4 years goes by and they're still saving for their deposit. You need to really understand how long it's going to take you to save that deposit. You need to delay gratification, delay going on the holidays, delay buying the brand new cars. And if you can stick to what your goals are, you're going to be able to achieve that. So for me, it was 4 years before I even got into my first property. But I knew what I wanted to achieve long term. And that was, I wanted to be able to pretty much choose what I wanted to do for the rest of my life. If I didn't want to work, I didn't have to work. And that's what I wanted to be able to do by the time I hit my 30s. So I knew by 20 years old that I had a decade to make that happen for myself, and that if I was going to just blow all my money in between that, then it wasn't going to work out. So I had to be really strict to be able to save the amounts required to build the portfolio. And I knew I needed as much assets as I possibly can early as possible so that I could have those grow. I think that with, a lot of people, they are saving for a deposit, and then all of a sudden a year goes by and they go, oh, well, you know what, this was too hard, I'm going to go to Europe. And then all of a sudden they blow their money in Europe, then they come back with no money and they have to start all over again. So understanding the timeframes that you need to get into the property, how long it will take you, and then working on it constantly year by year.
Yeah, I love that. And a lot of conversations I have with younger people, younger listeners who always reach out and give me some feedback and all that sort of stuff. They say, oh, it's just, how can I save, a 10% deposit on a $500,000, like $50,000 seems like a lot of money to save for me. And firstly, you touched on, you can actually find properties at a lower price to leverage yourself into that. And secondly, it is that delayed gratification piece. It is being able to slowly build up wealth over time, slowly save money over time. It doesn't, and forecast it out and see it out and understand that if you're saving, $200 a week, you're going to be able to save X amount over a 4 year period. And once you've got that in your head and you're consistently saving that $200 per week, then you will eventually get there. It's just about not being able to spend it on the way. And if you can look at Daniel and his portfolio and his life, he's a great example of, it did take him 4 years, but look at the compound effect of his portfolio now. He's reaching his goals. He's getting to that end point. He's got all that equity in his portfolio because he has implemented delayed gratification. And I think you're a true example of that, mate. But I love what you touched on there around, your goals and all that sort of stuff and risk profile. And I think, the risk profile really does go into that sort of property value. Like how much do they want to spend? Are they comfortable spending $1 million on property? Yes or no? And I think goals and risk profile together are so essential to impact on what their portfolio is going to look like in the future. And how do you think, they should be looking at their goals and risk profiles before they delve into their first investment?
Yeah, I think with, risk profiles is when you're looking at building a portfolio, for me, it's not about, I know a lot of people talk about debt, and this is the scariest thing about investing or going out and buying property is all this debt that they're going to take on. And I think, looking at your risk profile before you even buy a property, you should know how to manage the debt before you even have done that. And that comes down to making sure that you have good cash buffers. So if you're going to say $50,000 or $30,000 or $40,000 for your first property, how much do you have left over to be able to cash flow that property? Because as you build a portfolio, you're going to need to build larger and larger buffers to be able to make sure that you can get this property or this portfolio from year 1 to year 15. And you want to be able to do that without stressing yourself out. That was what my biggest takeaway was over the last 10 years with building a property portfolio was, how can I build this portfolio without it stressing me out? Because that is why I'm building this portfolio to begin with, so that I can be stress-free in the future and I don't have to worry about money. But a lot of people will stress themselves out the whole way through building a portfolio. But if you had cash buffers and you already forecasted, before you even jumped into that property, you've already forecasted what was going to happen, how much money you need set aside, you already know what's going to happen with that property. And you know what? If you don't spend that money, you've got it sitting there for a rainy day. So cash buffers is one of the biggest things, working out what you need in cash buffers before you even buy the property. That will set your mind at ease for when you do buy the property, that you know that you're already protected and that you're going to be able to build the portfolio stress-free.
Yeah, I love that. And for someone who is still currently building out his portfolio, I'm in this kind of awkward situation at the moment where I paid a 10% deposit down for a property. I've now got to pay all my stamp duty and settlement costs. And I ran the numbers beforehand, and I still had a 6-month buffer after this purchase, but that was relying on pulling out equity from another property. So that second loan hasn't settled yet, where I haven't got that equity out. So I'm having to dig out of the 6 months which of cash buffers, which is fine, and the other loan's been fully approved, so it's going to settle in the next week or so. But I'm in this kind of awkward little transition where I don't have that 6 months on hand, and I have had a couple of sleepless nights. Like, I still feel a little bit uncomfortable about it because I can't physically, I know it's coming, but it's not physically in my account. And it's so funny to see how I can be so passionate and excited and raring to go to buy this property when I know that I've got those cash buffers in hand. But then, as soon as you transition into being a little bit awkward, I think I've got 3 months on hand at the moment, which is still fine, but it's still a little bit uncomfortable. It's you feel it at night. You can't sleep as well. And I think, that's bang on to the point where you got to have these cash buffers in hand to be able to sleep better at night, to understand what you're doing, to see what your risk profiles are, to align your goals to them, and then continue to build that portfolio over the years. And I think you've touched on it just briefly before, but when you are searching for a property, we do tend to stick to the areas we do know. We tend to stay, mum and dad have lived in this area for ages. My friend from high school have just bought in this area. I should be able to buy in this area. And we have these little confirmation biases, this is where I should live, this is where I should buy, this is what I should be purchasing. And do you think this is the right way of thinking, or as you were saying before, should we always be thinking about Australia-wide? We're buying a property on a street, in a suburb, in a state. We're not just buying, around the corner from mum and dad.
Yeah, I mean, when I very first bought my first 2 properties, they were in, I think, 3 streets from where I lived. And, I was a young investor, 19 years old, and I thought that was the way to go because I could, touch and feel the investment. And I feel like a lot of people have that. It doesn't matter how old you are, if you're not a seasoned investor, then you're going to be looking at it pretty much the way that I did when I started out. Was I really need to know where that property is. I need to drive by that property all the time. After buying those first 2 properties, I realized very quickly that I couldn't care less about driving past those properties. They didn't change. They didn't run away from me. And that's one of the biggest things about it is people want to drive past it. I'm like, well, what do you think's going to change? You think you're going to drive past it, the roof is blown off or something? I think when it comes to investing, we need to look at Australia wide, and then we need to work out where's the best opportunity at that point. Because if not, then you're cutting yourself off from other investment locations. You're cutting yourself off from diversifying your portfolio. You might be buying in your own backyard, and that might be the worst investment possible. Whereas if you go invest in another state, it might be the right time for that state to grow. Each state grows at a different time frame. Each location grows at a different time frame. There are so many different markets within markets, and we need to know at that time where's the best market to buy in. And if you know how to correctly research that property or the area that you're going to buy, and you can research Australia-wide, you're going to have no troubles to be able to build your portfolio because you're going to be diversifying through different states. You're going to be diversifying different types of assets, and you're going to be able to build your portfolio a lot quicker. We need to treat this like a business. It's not emotional. I don't need to know what the colors look like. I don't need to know anything about that. I need to know the numbers. I need to know where it's located. I need to know, is it going to grow for me? Or if it's a cash flow play, what type of cash flow it's going to give to me. So for me, I'm now across 4 different states. I'm in all different locations with my 9 properties that I have. And to be honest, I don't need to drive past those properties. I don't need to look at them because they've got tenants in there. I have property managers that go through them. They do condition reports for me. They do all the necessary stuff to make sure that that property is getting looked after. And if I do need to paint the house or I do need to carpet the house, I can get qualified professionals to go in there and do that. They can do that within a week, get it back up for a rent, and I could go out there and continue doing what I do best, which is, invest, looking for new areas, or maybe even going to work and, having a higher productivity being at work instead of focusing on painting the house or, which is, I think a lot of people get caught up, and that's a mindset thing as well. I have to be able to do everything. That's why it needs to be in my backyard. I have to be able to paint the property. I have to. But what they need to really understand is that really the best use for you to go in there and, paint a property if you don't really know how to paint a property or you're not good at it? Or should you just pay for a professional to do that, rent the property out, get it all sorted, then you don't have to worry about it again. If you do it that way, you're going to be a lot less stressed building a portfolio. If you're constantly painting properties, so like my 9 properties, if I'm just constantly painting a property every year, I'm going to get sick of property investing. And because I'm just constantly trying to fix these houses up or do different things to them. However, if I have professionals do this for me, I don't need to stress about that type of thing. I know that it's all going to get taken care of for me. I'm focusing on the bigger picture. And the bigger picture is, how much money is this going to make for me in the future, capital growth wise? However, what's it going to give me cash flow wise? How am I going to get the passive income from that so I can live off it and then I don't need to do anything? And that's the real goal. So I think people are focusing a little bit different, So I think that when it comes to investing, think Australia-wide, but you do need to know how to do the research. We need to invest off the data rather than the emotion. And I think that's where most people get it wrong with investing, is they want to go off emotion, location and emotion, whereas I go off data and what's actually happening and why it will grow.
Yeah, I think you're spot on. And I think, the whole enticesiveness of building a property portfolio is to eventually have enough passive income that's going to supplement, your wage or your income that you're earning now. Like that's what drew me in, and that's what's drawn a lot of other guests on this podcast in. And I think that's what draws most people in. And so, that's very different to active investing. Active investing is that renovation strategy, that painting strategy, that manufacturing equity strategy. They're two very separate things. As a passive investor, you want to receive an email from your property manager once a year saying, yep, everything's good, tenant's still in, these are some repair items, this is a minor defect that we fixed, but here's the rest of your statistics, and you're neutrally geared for the year, or whatever it may be. You don't want to have to constantly be worried. And I guess this comes back to that conversation of sleepless nights. If you were in Daniel's shoes and you felt like you had to paint every single one of your properties, that would be daunting. You'd be up all night thinking, I've got to get there tomorrow, I've got to paint this, got to do that. But that passive side of things is really, as Daniel is saying, employ peoples as investors. It's a business. You're employing people, you're employing the painter, you're employing the property manager, you're employing the buyer's agent, if you need one, to source these properties for you, so that you don't have to have those headaches. Investing can just be a business. It doesn't have to be, 100 hours all the time, once a year, blah, 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 blah. You can just do, 10 hours of property per year or whatever it may be, and have that passive income and build it over time. So I think you're spot on there. And talking about, looking at our portfolios and assessing what properties we've got in it and all that sort of stuff. Do you think we should be constantly reviewing our property, or should we leave it for like every 5 years or something?
I think that, you should always be looking at your portfolio and seeing where it can improve. Does this house need a renovation? And when we talk about the renovation side of things, it doesn't, even though it is somewhat active, you've got to, do a renovation. And I've done renovations on properties. However, I'm not physically doing them. It's like a developer, right? As a developer, you don't go out there and say, righto, let's just do a 3 to 4 townhouse development. Let me get building. You don't do that. What you do is you say, let me employ some people to build these 4 townhouses. And I do the exact same thing with properties, right? I say, let me work out what I need to do to get this renovation done. And then I go employ people to get the renovation done so that I can continue to work and earn money where I earn money. And then they can do a really good job of renovating my property. And then it's all tax deductible as well, right? And then I'm not going to get sick of investing because I'm spending months and months and months with a vacant property, and at the end of the day, it's probably, better off. So I do think that when it comes to property investing, you need to be actively looking at your portfolio. Where can I improve? Can I improve on interest rates? Can I improve on, your finance structure? Can I improve on maybe extracting equity out of a property to go buy another property? So you do need to be active in your property investing and that side of things on how can we grow it? How can we monetize, what we've got? How can we improve our systems? If you do that, then you're going to have a real good streamlined property portfolio at the end of it. And, like I said, you don't want to be sitting 5 years and then realize you've got all this equity that you could have used 5 years ago. You want to know what type of equity you've got each year. And that comes down to, looking at what type of properties are selling for in the market. Maybe going and get a valuation with your bank to see if you've got any equity there to release. I think though, when it comes down to it though, you do need a team to do this. Like I said, I don't do this stuff on my own. This isn't just me creating a successful portfolio by myself. I have a team. My accountant will tell me how efficient I was tax-wise that year for my portfolio. My finance broker would tell me if I can get better interest rates or whether I'm going, well from a finance structure perspective from the finance side of things, or whether I can extract equity. So I have him on board. We've got people that look for the properties, the buyer's agents. You need to put that team together so that you have the specialists in every area to make sure that your portfolio is running effectively and that you're getting the best information at hand to continue to build the portfolio. But you always do need to be active somewhat to make sure that you are streamlining that portfolio.
And I think that's a great distinction around the mindset that you should have as an active investor. And I think a lot of people get this confused as well. Like I hear people all the time saying, well, to be an active investor, I have to be renovating, I have to be manufacturing equity, I have to be doing all that stuff. And, I could even categorize that as an active painter. You know what I mean? If you're painting properties all the time, where as an active investor, it is doing those things. It is reviewing your mortgages. It is reviewing your interest amounts. It is reviewing your portfolio and seeing how much equity you've got available and how your safety buffers are going with the savings on top of that. And can you go again? And talking to all these people that Daniel is talking about and getting them to communicate with themselves even until you get to the point where, your mortgage broker's calling you up saying, hey, I think your property's ready to go again. I think you've got enough in the savings and we can go again and build that real A team around you so that you're getting advice, you're feeling confident, you're feeling comfortable. And again, that comes back to what Daniel was originally saying is just having that laser focus mindset and having people around you that can, laser focus in with you and be guidance and put you on the same path so that you can achieve your end goals. And I think what I commonly see a lot is when people sign a contract for a property, sometimes they instantly feel like it's a lot of debt. Like, oh, I think I've overpaid for the property. It could be the wrong property. And they go through this process of buyer's remorse. They think, oh, I could have bought something else or I should have bought in this other area. And I think, you can clarify this for us, Daniel, but having that A team around you is what's going to stop you from having those thought processes. Are you on the same page?
Yeah, definitely. I mean, it's working out whether that property is going to be the right fit for you. I mean, having the buyer's remorse is something that most people will always have, including myself. You always have an uncomfortable feeling because you've just made a massive leap. And what I like to think of it as is every time I'm uncomfortable because I bought a property or I did something, so large like that, I'm looking at it from a perspective to say, anytime I'm uncomfortable about that situation, it's because I'm in a state of growth. I'm trying to expand something in my life that's going to help me grow. And therefore, I feel uncomfortable about the situation. And then 3 months, 4 months goes by, the property's sitting there doing its thing. And now all of a sudden you're not feeling uncomfortable about it. Why? Because it's become normal again, right? Oh, I've got that property. Yeah, that's the property that I bought 4 months ago. But at the time, it's a little bit uncomfortable because you're trying to put yourself in a state of growth. But if you have the team around you, they can rationalize this for you. These are the properties that sold in the area. This is the property that you bought. This is the price that you paid for that property. You can rationalize why you bought that property. How does it fit into your strategy? And if you can rationalize that with the team that you have, then you know why you're buying it property. So you can rationalize the uncomfortable situation that you think you're in, and then rationalize it so that you know why you are actually doing that, why you're buying that property. And that's one of the big keys is if you're trying to do this on your own and you don't have a team around you, you're going to feel very uncomfortable because you don't know what you're doing. That's why you feel uncomfortable. You don't know why you're doing it. You don't know if it's going to be the right strategy for you. You don't know if you're going to pay the right price for the property. You might not know the area very well. And that's what's making you feel uncomfortable. If you have the right team around you, you should be able to tick everything off about that property and understand why it's going to suit your strategy. And that's how you rationalize being uncomfortable about that situation of buying the property.
Yeah, I think that's perfect. And I recently finished reading Ray Dalio's book, and essentially what he goes on about in some retrospect is pain plus reflection equals progress. And I think this is a key fundamental is whenever, and he came up with this concept of the pain button. So whenever you're feeling pain, you click the pain button, you write down how you're feeling and you reflect on that. And essentially, if I put this in a property investing circumstance, if you're feeling buyer's remorse, like you've purchased the wrong property, slap the pain button, write down what you're feeling, how you're feeling, and all that sort of stuff. And then actually go away and just leave it there for a week and come back a week later and go back and analyze why you felt like that and go back and analyze why you bought the property in the first place and do all of that due diligence again, even if you've already bought the property and you've done your due diligence, but do it again and find all the reasons of why you wanted to go ahead with that in the first place. And then what that really does is it gives you progress. So next time you feel like that, next time you feel like, oh, did I make the wrong decision? You actually go, hang on, I've actually been through this before. I've actually looked at the numbers. I've actually done the due diligence. I'm actually still happy with how everything's going, and you move on, you progress, and it's just this constant loop of progress moving forward. So pain, reflection, progress, pain, reflection, progress. And I think that's super critical to not only invest in your own personal life, but in your investing portfolio as well. Now, Daniel, for the people that get it wrong the first time, and there are a lot of people out there that do get it wrong the first time, it's very easy for them to feel like, oh, I don't know what I'm doing. I shouldn't be doing this. I shouldn't have bought a property. I shouldn't have, done this investing journey. And they kind of just stop altogether. How does someone in this circumstance overcome the position that they're in now?
I think, a lot of people will label that as a failure. They go, I made a mistake, I failed, and then they can't overcome that failure. They pretty much go, you know what, this isn't for me. I'm uncomfortable about that failure. I think what you need to do is really look at the failure and say, what did I learn from that failure? It's not really a failure. It's what you're learning from the mistake that you thought you made. So let's say you made a mistake in property. You need to understand what the mistake was so that you never do make that mistake again, right? And I have made mistakes along the way. If you sit down with a heap of people and you look at the most successful people and you had a chat with every one of them, the most successful people out of the crowd would be the ones that would tell you all their failures and how many times they failed, but also they'll be saying that was probably the point in their life where they learnt the most. And to succeed, you need to fail and learn. And then you need to learn from the mistake. It's only a failure if you don't learn from the mistake and you keep doing it over and over and over. But if you can learn from that, you will never do it again. I remember when I very first started investing, and I had two opportunities in Sydney, and this is about 2012, two properties there I could have bought. And I actually put contracts on both of these properties. Now, both the properties were about 500-ish thousand. Maybe one was about 480, I think it was. One of them was subdividable. The other one wasn't. However, we just went through a massive growth period in Sydney where prices doubled, the following 5-6 years. Now, I made a massive mistake, or one would see as a failure. It actually cost me $1 million in extra equity that I would have made in my portfolio because I backed out of both of those deals because I didn't really understand about, I was going to pay lender's mortgage insurance. The lender's mortgage insurance to me was something that was quite high in price. And I thought, you know what? Do I really want to spend this money on lender's mortgage insurance? That's waste of money. Stuff this, I'm going to not buy those two properties. I look back now, those properties cost me $500,000 each in equity. So that's $1 million in equity because I didn't want to spend at that time about $20,000 for both of those properties in lender's mortgage insurance. I learned a massive lesson after that, not to do that again. Don't focus on the savings, focus on the opportunity. So I learned at that point that when I was back then, what I was actually doing was focusing on how much money could I save. However, I was losing sight of the opportunities of what those properties could have done for me over the next 10 years, 20 years, 30 years. Those properties would have not only given me $1 million, they would have been giving me passive income for life. So I think that when it comes down to failures, you really need to understand and dissect where you think you went wrong, understand why you went wrong, and then react to that and say, how can I do things differently next time so that I can learn from that? Because if you do enough of that, to be honest, you're going to become an expert in that field because you know what not to do and you know what to do. And that's what's, comes with experience. I've been investing now over a decade. I've had to come up with a lot of these, or I've had to go through a lot of these micro failures where people now look at me and say, oh, that wasn't a failure. Look where you are now. No, it wasn't a failure. But what it did do is it taught me not to do that again so that I could make more money in the future. So I think it just comes down to how you look at things.
Yeah, for sure. And if you are in that position and you are still listening to podcasts like this, I think, you already are on that process. I know a lot of people that have reached out to me after listening to my podcast saying, I bought an off the plan apartment. I bought a house and land package. I bought the wrong investment. I haven't seen any growth for the last 5 years, and they're kind of fretting and stressed. And they are in that mindset that they're a failure. That they shouldn't be investing. That they're making the wrong decisions. But because they're still listening to a property podcast and have realized that they've made the mistake, because we do talk about those sorts of things and those sorts of investments, that they've come to the realization, okay, well, yes, I may have made a mistake. I may see some growth over 30 years. That's okay. But moving forward, I can avoid making those mistakes. And I guess that's why, one of the final questions I always ask my guests is, what are the biggest mistakes that you've made? And hopefully what people get out of that is all of the learnings and understandings of what not to do, because once you learn what not to do, you can start to learn what to do and make your own little mistakes in what you do. But at least you're not making those huge, big mistakes that other people have done, because you've learned from other people. So you're definitely on the right track if you are in that position. So in the markets that we're seeing or experiencing today, it is very easy to get caught up in those headlines, to get caught up in, YouTube videos saying 30% price drops, in, certain people in certain areas saying, the property market's going to fall, that all the big banks are saying this. But news is constantly changing every day too. So there's a lot of uncertainty. And I know you mentioned before about laser focusing in, but how do we stay away from these sorts of thought processes or getting caught up in what the media says?
Well, for me, I've had to do this. So I've come out of the GFC and I started investing on the tail end of the GFC when no one was investing. Properties, were sitting on the market. People were talking about, the biggest economic crisis we'll ever see. And we're coming out of the GFC. However, everyone thought that was, we're going to go back into it again. They thought it was going to be almost like a second wave of it. And no one wanted properties. But for me, I always bought properties in line with my goals. I always bought any asset in line with my goals. And I didn't let anyone deter me from doing that. And I had people telling me all the time back then in 2011 that I was stupid for doing what I was doing. Why would you buy an asset at this time? Why would you buy a property at this time? Don't you know that people are talking about how much properties have crashed? For me, I rationalized it always was, am I going to reach my goal over the next 15 years? I always set goals that were long-term, 15 years, because if you set a 1-year goal like that and you say, I'm going to buy this property and I hope it performs over the next 12 months, you're then going to get deterred from buying that asset because you're thinking short-term. I always think long-term. How is this going to affect me 15 years from now? I bought properties, that they were talking about. They're going to drop. This was in 2011 or 12. And my one question I asked to myself was, this property here, do I believe that this is going to go up over the next 15 years? If I answered no, I wouldn't buy it. My answer was yes. And I looked at that because history has shown me over a 15-year period, Sydney has never declined 15 years consecutive, right? So because of that, I went, there's a pretty fair chance that I'm going to win and I'm going to make money out of this. Not only that, within the 15 years, I'm going to execute on my goals. And that is, I could even pay down that debt. Well, not me. The tenants will pay down the debt. And I'm going to be able to create passive income. So I already know that I'm guaranteed to create passive income in 15 years, regardless of what the market does, because it's going to be paying down if I need to do it that way. But I also know that in my heart that I looked at that and said, this is going to grow in the next 15 years. So I rationalized the situation and went, I couldn't care what happens over the next 12 months in the market, because I know long-term it's going to fit my strategy to buy these assets when I have the money to buy the assets. The problem is look, most people, what they're doing is they're thinking about things that they can't control, and then they're obsessing about those things about what they can't control. I don't like to obsess over anything that I can't control. I will only look at things that I can control. So I can control, should I buy that property? Why should I buy that property? Rationalize how it's going to fit my strategy. However, people will think about, what happens if it drops 30%? You can't control that. What happens if it goes up 30%? You can't control that. So why don't you just think about the strategy that you're looking to execute on? work out your time frames, and then continue to buy those assets along those period of time until you hit your goals. So for me, over that period of time, I've heard nothing, my whole career in property investing has been the exact same, where there's people that will always talk negative about the property market. And you know what? Those same people have been sitting on the sidelines for 20 years. And those people could have bought properties 20 years ago and they're like, oh no, but in 2004, there was definitely going to be a crash, or 2008. Yeah, see, the crash happened in 2008. But you know what? If you just bought the market in 2004 and held it for the last 20 years, you would have tripled your money. So why didn't you just hold it for the long term? That's where it comes down to thinking long term. If I think long term, I'm not going to get caught up in the short term ups and downs and what's going to happen with the markets. I don't want to read into the media, because at the end of the day, the media doesn't know what they're talking about. They usually come to people like me and ask for stories. I can tell them whatever I want and they'll print it. So don't believe outside influences like media, friends, and family. Look at your goals. Look at what you're trying to attain over a 15-year period and go after it regardless of what's happening. Because at the end of the day, if you do it safely, as long as you have your cash buffers in place, you're going to get to the other side and you're going to benefit from it. Trust me, I've done it. I've lived through it. And if I didn't invest over the last 10 years, I would have cost myself over $2 million. But I went through that period. Right? I went through that period of really people thinking that it was not going to work out for people like me. Oh, the markets are going to crash. We're going to go into doom and gloom. And guess what? It would have cost me $2 million and I would have still been sitting on the sidelines.
And I think that ties in a lot to, people who try and time the market. And I've always been a big advocate of time in the market over timing the market. And I think, given a real life example of me recently, there's all this media out there at the moment. I could get caught up in it, and I'll put my hand up and say, some days I wake up and read something and think a bit negatively, and then I have to realign myself to the right path. But essentially the way I was thinking, well, if property prices did crash another 30%, I might not be able to get the funding that I have today to buy again at that point in time to try and time the market. Where got my bunny ears going on now, but essentially, it's all about when you can afford to and when is the right time for you. If you're in the position to execute on something today, but you're scared about it dropping by 10% tomorrow, well then, if you're only looking sort of 1 to 5 years, maybe property investing isn't the best strategy for you. And that's why we always bang on about, at least a 10-year play. And if you can, 30, 40, 50 years play, 60 years play, legacy play, like have it for the next generation. And that's how you really compound and build wealth over time. It's not just I'm going to buy today and then sell in 5 years if it drops by 10%, or if it goes up in 10%, go up by 10%, then I'll sell and make a profit. It's that compound effect over time, and you've really got to understand that before you're worried about it. Like for me in my recent purchase, like I don't mind if the property crashes another 10%, because I know in 30 years time I'm going to look back and laugh at myself for worrying about a 10% dip, because the growth over that period of time would be exponential to the point that it would even seem not significant at all. Like it would be minuscule. So I think
if you talk on that as well, like let's say there's a property and you're going to buy that property. Let's say you bought the property, drops 10%. On paper, it drops 10%. You actually haven't lost anything, but on paper, it dropped 10%. Now, your cash flows are exactly the same on that property. So let's say you bought that property, you worked the cash flows out. The property was cash flow neutral. Now, yes, you would have went, oh, geez, if it dropped 10%, I bought then. But you know what? No one's going to pick that. I don't care how good of an investor you are. You'll never pick the bottom. Now, let's say, though, if you didn't buy that property, it goes up 10%. Now, all of a sudden, your cash flows are negative. And they're negative for a lot longer because you've now paid 10% more for it. It's going to cost not only more time to pay that property off, it's going to cost more money to pay that property off, and your cash flows are going to be more negative, right? But if you had bought the property and dropped 10%, it doesn't affect your cash flows whatsoever because it's something that's not real because you haven't sold the property. So I think that's also very important to understand is I would rather buy the property and it go down 10% than back up 10% down the track. Or if I buy that property and let's say it didn't drop and then it went up 10 or 15%, I'm now paying more for it. It's going to take me longer to pay it off. It's going to be a negative cash or more negative cash flow than what it was. And I've now got a property that I paid more for. I would rather it that way. And if you look at it from that perspective, you will understand that, okay, it's about, like you said, being in the market for the long period of time and the little fluctuations fluctuations like that won't really matter. At the end of the day, it's all about being in the market.
Yeah, spot on. And I think, it's not an actual loss until you realize it, until you sell it, until you execute on it. If you sell it at a lower price, then you've actually made a loss. But if you can afford to hold on to it, if it's neutrally geared and the cash flow is the same or negatively geared and you can still hold on to it, then, if you're holding on to it for the long term, it's only a paper loss. It doesn't mean anything apart from, in your head, you're thinking you've lost money, but you haven't realized the execution.
Yeah, and from a mindset side of things, if we talked about this, right, we've got to dissect the mindset of this, right? Because most people will look at it and say, I'm going to wait for it to drop in value. And then you say, okay, how much? If it drops 10%, will you buy? And the answer is no, I'm going to wait till it bottoms out. Okay, so you're more clever than anyone in Australia right now investing in property. And you know where the bottom is and no one else does. Because if everyone knows where the bottom is, everyone buys it. It's not the bottom, right? So you can accurately predict the bottom. So if it drops 10%, will you buy it? Probably not, because you're not looking for the bottom. What you're actually looking for is the rebound. You're looking for confidence. It's the mindset of you trying to protect yourself from the loss. So what you're actually looking for is, if it dropped 10%, I'm not going to buy it. Why? Because in your head, you're going to start saying, it's going to drop 20%. Let's say it did drop 20%. Then you'd be thinking it would be dropped 30%. However, the time that it rebounds, you're actually going to be buying in a market that's probably, and it can increase 10, 15% within months. And you won't even know that it's increased that period of time because the time that happens, everything's delayed. So it's more of a mindset thing. What they're actually doing is they're trying to protect themselves from the loss. So what they're saying is, I'm not going to buy it. They're actually waiting for confirmation that the market's going to grow. They're waiting for everyone to jump in the market. Once everyone jumps in, that person then jumps in with confidence going, it's all going to take off again, right? But the person that actually jumped in, they may have actually got a better deal. If it dropped 10% and they just jumped into the property market, they probably got a better deal because it could have bounced back very quickly. We actually had a client that had this exact scenario when coronavirus hit 12 weeks ago. We bought a property and then within 12 weeks later, we revalued that property at 10.8% higher than what it was 12 weeks ago because he bought at the peak fear. And that's why I say to people, if it's the peak fear and you don't want to buy that property, chances are it's the best time to buy that property because everyone else is thinking the same thing. Everyone else is thinking it's the worst time to buy the property. So whenever it's the worst time to buy the property, it's probably the best time to buy a property. When it's the best time to buy a property, it's probably the worst time to buy a property. It's always the opposite.
And to put that in layman's terms, I would much rather buy on the way going down because there's less people at the open home, there's less competitors, there's less people, putting in offers or being at auction. Even if there is an auction, there's most likely going to be private sale. Like there's so many other things that are on your side when it comes to negotiating and getting a better price on the way down. Then if you wait and you overshoot it and it starts to go back up again, well then all of a sudden there's 5, 6, 7, 10, 20 other people at the open home, at the auction. They're all bidding. They all want to get in. They've all got this FOMO, fear of missing out. And it's a big seller's market. And you're kind of just like, you're trying to scramble. And as Daniel says, this is how, the markets just grow so quickly because everyone's trying to get in before it goes back to a sort of normalized level. And so you might miss out on 1, 2, 3 properties. And then in 3 or 4 weeks, the market can just skyrocket. So it's much easier from my point of view, in my opinion, to get in. I'd rather get in at -5% and lose another 5% and then ride the wave back up than try and buy in at -10%, but then having to buy a positive 10% after that anyway. So I think that's a great mindset.
And no one will ever see it too, right? No one will ever see it. I see it because I'm in the market 24/7. But we just made, like I said, the 10%, bit over 10% for that one client. That will never get reported that the market just bounced back 10% because they didn't even know it dropped 10%. And that is the problem with it, is it's not recorded accurately enough. It's recorded delayed. So whenever you say, the market just dropped 3%, that was 3 months ago. The market's completely different today. I can look at a market and go to an open home and start to feel it and say, there are heaps of buyers here. The market's changed. However, the data says -3% because it's 3 months old. And that's the problem with it. It's after the fact. The time that you see that it's happened and that it's been recorded, it's happened, the market's completely different.
And that's why it's so essential, again, just to have that A team around you to give you that guidance, see what's going on the ground. These professionals do it every single day. They breathe it, they dream about it, they think about it, they're worried about it, their lives are surrounded by it. So if you can bounce some ideas and concepts and market feel off your A team, then you can distill that confidence back into yourself. Finally, Daniel, I just want to touch on alternative strategies. And I think this is a big one that a lot of people get caught up in as well, is they kind of, hear stories of people generating 100K equity from a renovation, or, making a 200K turnaround because they bought in Tasmania when it was going crazy, and they kind of switch their strategy, like just off a whim, just off a success story. And they think that that's now the new way to go. And they kind of derail from what their original goals and risk profile was. And how do we stop derailing, or do you think we should derail? I mean, how do you see that sort of play out?
Yeah, I mean, I think a lot of the people that derail in anything in terms of making money is because they're trying to get rich quicker. That's how I usually see it, is they're jumping from one thing to another, hoping that one thing's going to pay off for them in the short term. They're not thinking long term. I mean, you need to stick to what you know, what you're good at. You need to learn what you want to learn. So if you're going to look and go down developing, you probably want to learn everything about developing before you develop, right? A lot of people will go, oh, developing looks great. They get into it, they lose their butt out of it, and they go broke. And that's the majority of developers, right? They don't talk about the 95% of developers that go broke. They just talk about the 0.1% that made it because they've posted that on social media that they've done well out of that one project. However, 5 years later, they've just lost everything. And that's where you need to really understand the niche that you're going to go into, have a strategy in place. Don't change from the strategy. Like for me, my strategy has always been the same. I'm going to buy for the long term. I'm always going to be creating wealth, and over the long term, I'm going to create passive income. I diversify my properties between high growth and cash flow properties. You don't need to have one or the other, but you can actually combine them both together to get high cash flow and good capital growth properties. And that comes down to the research. And then I buy Australia wide, and it just depends on where I believe the best market's going to be at that point. So what state's going to grow at that point, and then I go buy in those markets. My strategy hasn't changed over 10 years, and it's worked so well. So why would I change it? The people that don't really ever succeed are the people that have changed strategies 5 times and they've never stuck to one thing. So they're not really good at anything. They're just sort of jumping from one to another and hope one sticks. Whereas you really need to become, I guess, an expert, a master in your strategy so that you know exactly what your strategy is and why you're executing on it. If you do that and you think long-term and you continue to beat on that craft over the long periods of time, you're going to become a master at it, and you're going to become an expert, and you won't make any mistakes.
100%. Double down. I'm a fan of Gary Vee, and he says that all the time. He just says, double down on what you know, double down on what you're good at, double down at what you're comfortable with, and stick to that strategy. I mean, there's so many people, and we've seen it recently. They've switched to stocks. They've opened up, these Robinhood accounts and gone down all these different strategies. And to be frank, like they might not have any idea about the share market or what's happening, or how they've just seen, everyone's just gotten in at the bottom and now they're riding this wave up to the top and everyone's making money. But you never know what the share market's going to do tomorrow. I mean, it's everyone's talking right now about how uncorrelated, what's happening over in America is to the share price over there. So, it's just... Yeah. You got to double down on what you know, stick to your strategy, stick to your goals, align yourself from the beginning and ride the wave, ride your own wave. Don't ride anyone else's wave, ride your own wave. And I think that's super critical around mindset. Is there anything else, Daniel, that you just want to touch on finally in terms of mindset?
Yeah, I mean, like you just said there, it's sort of like a fool and his money will part ways, very soon. And that's what it is. If you're going into something and you're not skilled at it and you're the fool, you're going to lose your money. And that's what it is. People trying to go from stocks to real estate to Bitcoin they're jumping on the next thing, right? The next thing to get rich. You try and get rich, you get broke, you go broke, right? That's just generally how it happens. I very rarely see someone just go, you know what? I went from like trying to do e-commerce to be a stockbroker to be a real estate investor, and then just went, one of them stuck and I made millions. Generally, they've doubled down on one thing long enough to be able to become a master at that one thing. And it's not to say one thing is better than another. It's to say what is your thing, right? What's your niche? And then double down on your niche, your strategy to build that over the long periods of time. I'm not going to just go throw $2 million in the share market tomorrow, because to me, yes, I understand it, but it's not me. It's not who I am. I would rather put that in the property market because that's what I study. So, whereas some people that love stocks and love shares, they're going to build that portfolio in share market and probably say the same thing about property because they don't understand property. They understand the share market. So just double down on what you know, get a good team around you, and make sure you need to understand that you can't do everything yourself. That is one of the biggest things that I've learned over my years is I can't do everything myself. I need to leverage, and leverage is the key to be able to create success. You need to leverage other people that are successful in their right to be able to help you succeed in what you're trying to do.
Mate, I think that is fantastic advice. And I think we've touched on some really fundamental mindset concepts today. Even just listening to you before, there's some things that I'm taking on board, and I'm fully on board of, tuning my mindset every single morning, waking up and realigning myself and making sure that I'm laser focused. And it's just been a great conversation, mate. And I'm sure the listeners are going to get a ton out of it. So thanks again for coming on.
No worries. Thanks, Jordan. Thanks for having me back as well.
Daniel is an absolute legend. He always has incredible insights and has even made me refocus back onto what I had originally set out to do. I'm always looking for more guests to come onto the show. If you're under 30 and have one or more investment properties, whether it's good, bad or ugly, I would love to talk to you about it. Even if you're interested into getting into the property sector, let's have a chat. The main focus is to help other soon-to-be young investors with tips and tricks along the journey, learn from the mistakes that we have made, and ignite the fire to set themselves up financially for the rest of their lives. If you're interested in sharing a story, you can go to jordandeong.com/podcast, where there's a podcast inquiry button at the top that will guide you through the next steps. If you want to see what else I'm up to, you can go to YouTube and type in Jordan de Jong, where you'll find the Smashed Avo Property podcast being hosted on YouTube, and plenty of other content that I'm putting out consistently. If you're keen for more content like this, make sure you subscribe, and please leave us a review with any feedback for future podcasts. And until next time, happy house hunting.